another edition of the Market Technicians Association's educational web series. My name is Shane Squark, and after a long 2-week break, I'm thrilled to welcome you back to another webcast as we are joined by Alex Bernal, CMT, to present cycle analysis of the markets. Alex is a chartered market technician with many years of industry experience in the equity, commodity, currency, interest rate, and derivatives markets. He is known for his methodical approach to identifying key cycles, market anomalies, unusual order flow, profitable chart patterns, and early trend developments for trading opportunities. Alex has appeared in several media outlets, including Bloomberg and TheStreet.com. He currently operates a private technical research and algorithm development company by the name of Aether Analytics out of beautiful Santa Barbara, California. Previously, Alex worked as a trader for M&M Trading, LLC, where he traded yield curve futures and was mentored by veteran trader Anthony Lazzara, who was once the largest 5-year Treasuries floor trader at the Chicago Board of Trade. As a reminder, we do accept your questions throughout the entire webcast. You may submit them by using the chat pod at the lower left-hand corner of your presentation window. However, in the interest of time, we will not address your questions until the very end of the presentation. For those interested, a recording of this presentation will be made available in the MTA's knowledge base and in the on-demand video archives by the end of the week. That said, it's without any further ado, I'd like to turn the stage over to Mr. Alex Bernal.
Thanks, Shane. Hello, everybody. I want to thank you guys for having me today, and hopefully this will be a nice little presentation and everybody will get some good education out of it. The topic for today is cycle analysis, and my goal of the presentation is more to present the fundamentals of cycle analysis and kind of talk a little bit more about the approaches, and particularly one specific approach, and not really get too involved with the mathematics and the scary mathematical formulas that might deter someone who's never seen cycle analysis. It was my view when I was discovering cycles and trying to learn about trading cycles in the markets that a lot of the technical analysis tools that I was using or learning about were mainly focused on the movement of price up and down along the y-axis, and there was not a lot of focus on time or movement along the x-axis. And so as I was studying people like Gann or Bradley Cohen, I came across this notion. The primary discovery in all of technical analysis is that time and price are the same manifestation and are interchangeable. This little sentence really hit home because this is something that it really encapsulated a lot of what I was looking for and trying to discover using these cycle tools that I'm going to show you today. When we're looking at markets and we're trying to forecast what they might be doing or what they should be doing, we're always thinking about two really key questions. What is a good price to buy? But rather, what is a good time to buy? And so I think this will be really great for you guys to see because this is a lot more focused on what time rather than what price. So I just want to cover first how I really have made this presentation and where I've kind of come to my conclusions with cycle analysis. There's been a lot of analysts before me that have really paved the way and done a lot of hard work in order to reveal some of the harder aspects of what we're about to see in my presentation. J.M. Hurst is considered the father of cycle analysis. There's a lot of tools that are still very relevant to today that people are using, as well as John Ehlers, his spectral dilation or his computer scanning algorithms that search for cycles in data are very much a staple or a linchpost to some of the things that we're doing. And everybody below, Walter Brezert, Lars von Theoden, Edward Dewey, Bradley Cohen, Charles Nenner, Martin Armstrong, and William Garrett are also very influential on my studies and helping me understand how cycles work in the market. So I highly recommend taking a look at any of these analysts' work. They'd have great stuff to offer on cycle analysis. So for theories of market action, I really like this slide because it kind of sets it up for why is cycle analysis relevant. And there's different theories about how prices move in the markets. Technical analysis is pretty much the theory of fractal pattern recognition and trend. Researchers like Mandelbrot really hammered this home, the fractal nature of how prices move. Additionally, there's the fundamental side, which we don't really focus on here at the MTA. They mainly look at earnings, dividends, price to earnings ratios, which is actually a technical statistic because it involves price. And they basically focus on the intrinsic value of what the security you're looking at is supposed to be priced at. Then there's actually this random walk side where people say the markets are unpredictable and lends to the beta factor or the risk of random movements within the markets. I found that the trouble with technical analysis sometimes is that it does have failures, and sometimes it doesn't really work over long periods of time, or specific tools stop working. In short term, they can be perfected, and traders can use them with management skills to have very successful trading. And fundamental analysis, there's this big problem where the best fundamentals are often seen at the top of bull markets, and the worst fundamentals are often seen at the bottom of markets. So it's kind of a paradox in that you might be looking at securities that could be the best to buy or the worst to buy, depending on how the fundamental are aligned at that time. The best thing about cycle analysis is it really can incorporate the two and kind of combine them all together, because as we can see when we're analyzing the data, we see that earnings have cycles, we see that Elliott waves have cycles, we see that a lot of different data points within the markets do have cycles involved. None are completely wrong or completely right, but the cycle analysis can really marry the two together in a fusion that I think is really important to keep in the back of your mind if you're going to be looking at cycle analysis. Since timing is such an indisputable element to making profits or controlling risk, to be blind of the cycles involved is to me kind of like building a house without a foundation. I really love cycle analysis because it doesn't really dispute any type of analysis technique. It kind of embraces them all. So that's why I really love this type of technique. And that being said, cycles or cycle analysis is not perfect. Cycles become extremely complex as you start to get deeper and deeper in how to use them. But when synchronization is achieved in the harmonics of cycles, timing can be actually pretty accurate. So Cycles 101, let's just do a little prelim about how cycles work. The word cyclos is actually Greek for ring or circle. It just means a specific event that has occurred at a specific number of regular intervals and observed to be continuing at regular intervals in the future. These systems from which cycles are derived are completely balanced affairs, not only in dimension but also in time as well. So there is a balance when looking at these cycles that lays to the effect that it's the actual movement of the cycles that keeps them in balance. It's pretty interesting little tidbit of information there. So the next thing is that cycles can be measured in time, which is what we're going to be focused on today, or that can be measured in space. So a lot of cycle analysis that I've come across has not really been uncovered from financial markets, but rather maybe physics or electrical engineering or such. One thing I do want to say in the beginning is that cycles are not perfect sine waves. You think of a cycle and you think of these perfect ripples across a chart. That might be the way that we lay it out, but to know in the beginning that cycles are not perfect sine waves and they do shift is very important, because then you'll have better expectations when using these tools going forward. So viewing the market as a cycle, you know, we start with the simplest notion as that we want to look at the market as one complete revolution of a series of events. And there's cycles in a lot of things around us all the time. There's lunar cycles, there's time cycles, days, weeks, months, years. There's weather cycles, you know, the seasons. There's agricultural planting cycles. There's human biological cycles, mutum and rhythm cycles. Obviously, economic and business cycles of war, and also astrological cycles as well to take into consideration. So with price and time analysis, each market will develop its own individual cycles. These cycles are just a repetition of the past in fractal geometric forms. And to me, they're really just expansions and recoils or detractions of these circular measurements that we're making, and they're often actually bound by pi and by phi. So that's really interesting because we use these Fibonacci tools all the time, and we kind of ignore, you know, one of the most amazing numbers, which is pi, which we'll see will bind a lot of these circles or cycles that we're looking at. And additionally, like I said, cycles are dynamic in nature. They do change, and they are forever changing. So we're going to take a look at that as well. And what that really means is they're not really static. So a lot of cycle topics I've seen as per trading in the markets is there this fixed number of year cycle or fixed number of day cycle or fixed number of movement cycle. And what I've uncovered is this is actually false, because there's an amount that it will change. There's a buffer zone to how much these cycles will move back and forth. So let's talk about a few of the things that are important to know before we look at, you know, cycles. We want to look at the vocabularies. First thing I want to talk about is really this thing called the phase angle. And what the phase angle really is when you're looking at a circle and you overlay it across a time axis, the phase angle is actually just the degree or where we are along the wave movement. So the phase angle is just where this dot is riding along the phase line. The second thing I want to talk about, or vocabulary term we want to learn, is the amplitude. The amplitude is just the distance away from the mean or the middle of where the cycle is measured. This is a very important thing to understand because this is going to lay into some of the things we're going to talk about, and also the wavelength. So just to visualize it, I always like to visualize things so I can understand it later. You have the amplitude is the up and down movement from the middle, and the wavelength is actually the periodicity of the cycle. So when we're viewing this market as a cycle, I really like one example where we take a look at the entire market or the cycles involved as sort of ripples, waves, and tides. And so underlying the market, there's always this larger term, bull factor, or this bear factor, pulling up or down on the market. I like that to the tide of the market, coming in and coming out, large amounts of money flow. Then there's actually these waves, which are sort of the swing waves, the seasonal, the ups and downs that make up the core of how the market's moving. You know, this would be like to the Elliott wave, 5-wave movements up, and maybe the 3-wave movements down. That's sort of the medium term, the waves. And then you have the ripples, which is sort of the day-to-day up and down noise that you see. And all of them combined will create this sort of composite wave that we're going to see in a few slides and how the market is affected by them. So let's talk about one basic method to finding cycles in the price data. There's many different ways, but I tried to really break it down into the simplest terms so everybody can understand what's a good way to find cycles in price data. Rather than counting them, you know, visually on a chart, I think that's a little bit too subjective. So what I've really arrived at in my own analysis is using a computer algorithm And what it basically does is it establishes a moving average of the data or regression from the price time data. So it looks for, the trend or the median line. It then converts the price time data into some type of low lag moving average. So this basically filters out the noise, gets rid of the unnecessary data to obtain the percent deviation from the base moving average that we established before. So then visually, or I would rather say statistically, using a Fourier transform, which is just a mathematical function, to obtain the cycles from in the data. So this is where we actually extract the different wavelengths or the periods involved in the cycles that we're looking for in the price data. The last thing that we have to do is look for ways to actually filter out all these waves that we found and find the ones that are the most important. And so, I'm not going to go into the equations involved, but the one that has been most useful for me is called the rank version of the von Neumann ratio test for randomness, which is basically a statistical significance test to whether or not this cycle underlying the market that we found is significant or not. Is it useful for us? There's other optimization techniques that you can use further on in this process to pre and post filter the data, and this will give better results depending on the markets that you're looking at. But in essence, a Fourier is just a mathematical transform that defines a function based upon the time series or vice versa. So I just wanted to talk about that a little bit because that's the basis of what this is all really founded on. So this is a great little picture from Walter Bressett's book, Power Cycle Oscillations. So this is a good visualization of what I was just trying to describe, where you have sort of a data series on the top of this panel, and the market is moving it in a upward wave, higher highs, higher lows. We can use a computer model to find the regression line or the median trend of this market movement, and then we can again extract the individual pieces that we need to look at the cycles. Again, using the algorithm to find the distance between the median line is very important because that is the amplitude, and then also the time frequency, the distance between the two peaks or more than two peaks, multiple peaks and troughs going forward is going to be really important. We then can detrend it and take it down so it's just the sine wave or the cycles along our lower panel here. So this is a great visualization of what actually is happening when we're using our algorithm to extract the cycles. So with this algorithm, this is basically the raw data. It looks a little daunting, but it's pretty simple to see. This is one that I spat out a couple days ago. I was analyzing the S&P, and the S&P will be the majority of the examples for today. And I'm looking at, a lot of different filters for the data. I'm only looking at about 3,000 bars, or from about, looks like 2001 to now. And you can see here I have a limit to how I'm setting up my Bartels. So this is really important because the adjustment of what cycles I am allowing the algorithm to find is really important. The higher the Bartels test is the most significant cycles involved. A Bartels test of about 98 is a perfect cycle, which we actually don't use because it'll leave out the other cycles that might be effective in the market that we still want to see. So you can see here that I've had this search for the cycles within the S&P 500. We are given the length of the cycle, the amplitude. Where these cycles actually start is really important because when I look at other analysts looking at cycles, they're actually taking subjective points on the chart. They're saying that this low or this high is where I'm going to start counting going forward. Well, I think that is a little less scientific than saying, where do these cycles fit based upon the mathematics. So I'm not choosing where these cycles start. They actually tell me where these cycles start based upon the bars that I have selected. Then we have a further filter by strength and then also by significance, and this is where we can rank and look at the cycles that are going to be relevant for applying to our charts. So strength, people asked me before my previous presentation, what is actually the strength? And so there's two key features when looking at cycles. One is the length, and the next one is the amplitude. Those are very important parts of the cycle to take into consideration. When you sort the cycles by the highest amplitudes, this will actually give you the cycles that are seen to have the most influence on the market long term. But when it comes to trading, we're actually interested more in the cyclical force per unit of time. So it's a little complicated, but basically it's better to sort, I've found it's better to sort these cycle components by level of influence with reference to price movement per bar. So in essence, we're basically dividing the amplitude by the cycle length to do a further filter, and this is more the strength of the cycle. So here's our first graph of the cycles that are involved in the S&P at the current time. You can see that we have a myriad of different lengths and different sizes of amplitude. And this is just the first step to looking at the cycles underneath the market. At first glance, it might be a little bit overwhelming because you're just like, whoa, what do I do with all this data? What is this really telling me? And the first thing that I just want to point out is how you can see that these cycles are not aligned perfectly for any given data set or series of dates. It's when we can see that these will align in the future that they become really interesting. And one point that I want to point out is right here, where I have this black arrow, is we've been seeing this coming for a few months since the beginning of the year, where there's this alignment of the major cycles, and they're all poised for a downward swing starting about at April, and they go through about early July, late June. So this is really interesting because just with the visual aspect, we can see that a lot of these cycles are going to start to be pulling to the downside, as we're going forward in the year in time. So I just wanted to go back to another little picture that Walter had in his books because, again, this was really important for the next step, is now that we have the individual cycles, we want to try to actually further combine them to get an even better forecast of how the markets are going to be moving up or down or even sideways. And so as you can see in the top panel, there's this trend component, which we've actually filtered out using the algorithm, but we now have extracted the big cycles and the long cycles. So the next tool that we're going to look at that I think is really important is called the cycle composite. And this is where we actually take the large cycle and the small cycles and we summation them, we add them together to get a composite forecast. And this is what you see when you take the large cycle data and the small cycle data and combine them together. You get more of a waveform that looks like what the market's actually doing. So here's actually the cycle composite for the S&P as of the current time. I think I ran this like yesterday, so this is pretty accurate. And you can see that it's been pretty close to the highs and lows over the past years about projecting the major trend movements or the major oscillations in the market. One of the things we did notice is that we had a cycle inversion here, which I'll talk about again in another couple slides, where the market actually went up against a low or a sideways movement in the cycle composite. But then it reattached, and we've been rising with the cycle composite up until about late March, early April, which we forecasted the market should see some type of medium-term top. As you can see, the cycles that have combined it have really pushed the composite so that it accelerates down into June. And so this is something that we are definitely looking at as far as a risk-off time in the S&P at least. So this is actually another cycle composite This is only using 4 cycles, so this was used so you could see that if I'm only using the 4 strongest cycles, this does have a slightly different composite and will give us a little bit of a different forecast. This is important to consider because when you're looking at different cycles, the question always arises, well, how many do I use? Why don't I just use 100 or 50 or 20 or even 10 of the strongest cycles to get the best composite? Well, we found that once you get past about 10, the composite starts to lose a lot of its important data. So it's sort of the control of how much noise do you want to actually give the waveform and how important is it going to be. So let me switch back to the previous slide. You could see a slight little difference. You know, this was pretty much a straight upshot on using 6 different composites. And you could see we actually had this pullback zone in between by using less of a composite. You'll also notice that the peaks will actually shift back left and right based upon how many underlying individual cycles you're going to be adding to the composite. And this will actually affect your forecast because typically we look at the peak as being a possible, topping zone, or the market should start to top near that peak, and vice versa for the bottoms as well. And it's this deformation that I want to talk about, because to understand how these combined cycles affect the composite is really important to understanding how the forecast is going to affect where the market might go. This is a really great example of how you take a 1-cycle sine wave and you add it to a 3-cycle sine wave, and even though you're adding the same 2 cycles together, if they have the slightly different periodicity, you can see the one on the left is basically inverted from the one on the right, you're going to get possibly severely different composite forms. So you could see in this composite we've had this flattening zone where if we saw this in the S&P composite, we would actually project more of a sideways low volatility corrective movement. Or on the right example, you can see we've had these huge peaks up, and we would actually expect sort of a blow-off top or a really strong move to the downside. So you can see this is only using 2 waves, and we're actually using upwards of 10 waves, and that's why this can get really complicated, is because these deformations can happen and they can really sort of affect the continuing forecast of the total composite. So to try to make a little bit more sense of this, I actually started to dive pretty deep into methods of geometric analysis, mostly related to circles or measurements of spherical mathematics. And one of the things that we're finding is that when you're looking at cycles, sometimes it gets very disappointing because the cycle sometimes refuses to work, or the power or the energy within the cycle sometimes just magically disappears and reappears. And this is where a lot of people that are looking at cycles get a little bit distraught, and they might leave it right then and there, because why would this happen, and why does it happen right when I need the cycle to kick in? So this is just going to hammer home one point, in that when you look at a sphere, a perfect sphere, and then you take sort of a bubble shape and it's moving through the air, one of the things that's really important is that no matter how this bubble is deforming by its outside energy affecting it, or how it's floating through the air, the circumference of the bubble is actually going to stay the same no matter how deformed it is. This is the one constant thing that we can always rely on with these wobble, or this wobble effect, or this elliptical nature that are actually starting to find in these cycles that we're looking at. So again, this touches back to the dynamic nature of the cycles, and that they're not fixed. They do have sort of a wobble or a distortion that will undulate back and forth, and it's sort of something that you have to account for when you're looking at some of these cycle composites. This is also a great little tool here to understand how the volume or the energy might affect these undulations or these movements of these cycles. This is from Walter Garrett's book, Power Torque. It's called Torque Cycles in Markets. And I thought this was a great depiction of how the energy is going to affect the market and how it looks through the cycles. You can see in the top panel here, this is basically a cycle that is going through 1/2 speed revolution. So speed we're going to liken to volume at this point and take a look at how that's going to affect the shape or the overlay of how the market works. So you can see with the half movement, we get this really clear jigsaw up and down of a cyclical movement. This would actually be likened to a perfect cycle, or to what most people will look at when they're looking at cycle movements. They're looking at the 13-week cycle, they're looking at the 3-month cycle, and they're really only accounting for the same speed or the same volume energy within the market. This is actually quite untrue, because we actually see there's times where the volume actually increases or decreases a lot. So you can see the second one down, this is where the speed has actually been changed to 1/4 rotation, so it only is moving 1/4 rotation per unit. And so this will actually give us a little bit more distorted of a waveform. And again, you can see the third panel down, this is a 3/4, so a little bit stronger. This is a little bit more energy, a little more volume speeding up. And this will give us a little bit more of an aggressive waveform. And the bottom, this is the most like how the markets really work, where you have this alternating energy. You might have 3/4 of a turn, 1/4 of a turn, 1/2 of the turn of the circumference, and you're actually going to see this more jagged waveform, typically likened to how the markets really move, where it's not quite symmetrical, but it still keeps the constant of this cyclical measurement within how it's rotating. So I know that's a little complex, but I think this is a really good way to understand why these cycles might not be perfect and why they are dynamic in nature. This is another example of how there's cycles within cycles. So with the volume being transacted, this is going to affect the bigger cycles and the cycles within. So the larger circle represents the big bull and bear markets, going up and going down. The volume is actually increasing, or should be increasing in theory, as the bull market, and then decreasing as the markets are pulling back. And within the larger term cycle, there's actually smaller cycles that are spinning, and this is where you get the jagged effect of the market's ups and downs as it travels along the larger term. This is actually a really important visualization, because there's always this crack the whip effect that we found with the cycle tops and bottoms, where as a market is reaching a larger term cycle top and the smaller term cycles are churning on top of the larger cycles, it might seem that the actual price action isn't really having a strong relationship with the market, the cycles that you're looking at, but all of a sudden it just takes it and wham, it gets slammed. So this is really like when the market goes up and it will sit kind of on a ledge, and then all of a sudden it just drops seemingly out of nowhere. It's because when these two cycles have enough time to align, they'll both be pulling down on it together, and then you get this strong dramatic move to the downside. It's more like to gears in a car in a way, accelerating and decelerating. So I just wanted to actually show you a live example of the S&P and how we've been looking at this from about last fall till now. So with the tool I have, I could actually back test our cycles and make sure the ones we are looking at are holding true, or the ones we should be focusing. So I've actually just deleted the price data to about November in the S&P, and I've overlaid the cycles that were relevant prior to the data at this point. And you can see that this forecast has the longer term cycles going up. So even though we had this dip, we were expecting a time to buy, or actually see a retracement. And this little trough here in November, where you can see these two smaller cycles, were a great time to actually identify the possible zone where it was going to bottom. So at this point, we were still expecting the market to continue along the longer cycle and have some type of topping formation after February into March. So let's fast forward a few more weeks. So you can see this was taken about end of February, and this is where we actually saw the peak of the cycle. And this is really important chart because I really want to make it clear that just because the composite has a peak at this point doesn't actually mean that that will be the exact top. Unfortunately, I wish it were so. The markets will actually top most of the time after a peak in the composite cycle we found with some of these charts. But at least we have a general forecast of how we think the market's going to behave over the coming months. We actually can see that there's a flat point, or this flat distortion between March and May, where we're actually looking for some type of sideways consolidated movement. And this would affect our trading decisions because instead of using outright trades, we were looking to be using possibly condors or butterflies in anticipation of a sideways movement of the market underlying these cycles. So I'm going to fast forward a little bit more to today. And so you can see the first thing that happened was the waveform actually distorted. So it does not quite look exactly how it did a few months or even 6 months prior, but the general forecast is still showing us that we have sort of a downward forecast for the remaining of the summer. Now, one thing that is really interesting is that this sideways forecast that we saw in the previous chart pretty much came to fruition. If we would have sold condors on the S&P, this pretty much did have a nice little sideways trough movement as per the composite forecast. So, we've seen quite a bit of action up and down in the market, and I believe that it's somewhat of a tremor, and we could be on the precipice of a nice little pullback here in the S&P down until about the June timeframe. So this is as of, I think, yesterday, and this is a live forecast. It's really funny that this actually, independent of the axiom sell in May and go away, has put a minor high and then a sell-off into May. So I think that's really interesting that these composite cycles will sometimes catch the seasonal cycles within them and sort of explain why they might happen. The next way we actually look at the S&P is we also put a composite cycle on the volatility VIX index. You can see right now that this is the live example of the VIX composite. To be honest, it's a little bit more confused than the S&P, but you could still see the general forecast for the volatility index is to increase until about June. And I always find this a really interesting way to look at the S&P and the VIX, because the way that we're looking at the VIX is completely independent of the S&P. This is a scan of merely just the VIX data. And so when the VIX data sort of aligns with the S&P forecast, we can be fairly confident that we're going to get the move in the direction that we're anticipating for the S&P. So we could use this type of analysis in other different types of combination techniques, looking at different markets that might be invertly correlated or that might be extremely correlated. So with that, I want to touch base on something called node alignment. This shows up a little bit more in music, but this is an important thing to touch base on, because when you have two waves or multiple waves of the same wavelength and they're vibrating exactly parallel to each other, their frequencies actually resonate in some type of a line or a like relationship. And it's even though the amplitudes and the phases, so even though the distance from the median and then the actual phase may differ, the vibrations will actually have similar or very close node points or 0 points. And this is a little bit used to make sense of all these complex waves when they're looked at together. So you can see this is an example of a 2 and 1 wave form, and you can see they have 3 constants, node points, in the middle. These are actually points in a chart where if we find a lot of the markets aligning to the same node point, this might be a time of extreme quiet or extreme trendless markets. So we can actually sort of predict trendless markets because of these alignments of these node points. So you can see even though there's a 3 and a 2 wave, there's still these 3 relationship node points together. We can go as far as even a 4 and a 3, and we can also get these 3 exact relationship node points. So this is another a little bit more advanced bullet point to looking at these different cycle relationships, but I thought this was really relevant when you're looking at how they're acting versus each other. So there's a lot of phenomena in cycles where it's a little bit hard to explain, and when reading a few different market technicians' books about cycle analysis, they get to the point where they're trying to look at when cycles are aligned in combination, maybe trying to predict or forecast the price movement up or down based upon the amplitude distance within the cycles. And so this is actually taken from a mathematics journal where they were taking two identical waveforms of the same power. And what's really interesting is that they often see that when you have the same energy in two waves, rationally you would think that you would just get double the amount of movement to the upside. Well, they actually catch and they amplify each other, just like in sound measurements. You'll actually get even more energy to the upside when they're perfectly aligned. So if this had a unit of 1, this has a unit of 1, you would expect it to move 2, but instead we actually sometimes see it move upwards of 4 or exponential amount from the expected movement using the combined amplitude. So that's really interesting to me, and this often happens a lot in cycles, and so I just think it's really relevant to take into consideration when you're looking at this going forward. The last little phenomenon that I want to touch base on is this phenomenon of opposing waves. And so again, rationally we would look at these and would say, okay, if we have a wave that has a phase structure like this, and we have a wave that's a phase structure like this, if we combine them, wouldn't we just get a flat line? Wouldn't the market just hold flat? And after really looking into this through a lot of different physics journals and electrical engineering journals, there's this theory that's been developed by this physicist Tom Bearden, and I'll crudely try to summarize it, but basically it says that when two cycles' energy are combined, they actually do not collapse to zero, but instead they create this sort of scalar stress wave, that he calls it, and which the combined forces, they actually compress without any loss of energy, and then they release to have an even greater amplitude. So much like the structure that we just saw previously, what's interesting is you would look at a forecast and think, okay, we're going to get a flat point into this market, and you actually might get an extreme movement because the energies underlying both opposing cycles will release in one direction. So this might explain why sometimes the cycles appear or disappear or have extreme compound effects within a market when they're very close to being a perfect 100-degree phase cycle to each other. And this brings the last little picture of lost energy. I'm still trying to figure out how the phenomenon of why these cycles try to appear and disappear, or they might shift. And I'm really coming upon the notion that there might be this sort of third axis, or this z-axis, that we're not accounting for in our model. And basically it has to do with sort of incorporating a spin or a spiral within the cycle component. So I know that's a little bit esoteric, but we're trying to figure out why this happens, and a lot of things are pointing us to this direction where we might be looking for a third axis and how to measure that and take into account to our forecast. So new areas of cycle research that I'm personally involved in and looking at are cycles with short-term interest rates. My background's in trading treasuries and interest rates, and we're finding really nice dependable cycles in these short-term products such as Eurodollars and Euribors versus T-bills and whatnot. Again, we're also using the cycle tools to look at indicators. So we're looking at cycles in oscillators such as the RSI, or cycles in trend such as the ADX, or the Arun, cycles in Arun oscillators, things like that. Another really big component that I'm involved in is measuring cycles in implied volatility, because when you're trading options, it's very important to possibly know if volatility is looking to increase or decrease over a certain amount of time. We're actually finding that the cycles that are in implied volatility are very asymmetric, and they're really difficult to track down. There's also intraday volume cycles that happen every day, institutional volume cycles that are very relevant. And there are people that are looking at ways to refine this asymmetric nature of implied volatility cycles, and they're starting to call it this chaos tuning factor. It's a little complicated, so I won't really go into it. And the last thing that we're trying to apply to this model is sort of a vortex mathematic technique, where we look at possibly taking a spherical measurement and turning into a rotating torus. So I know this is a little bit difficult to visualize, but geometrically, this is what we're trying to add, this type of component to our filter engine and our cycle measurement. So these are some cycle resources that I thought would be great for everybody. When I was first learning and trying to dive into cycle analysis, there wasn't really much out there, and I had to really dig deep. The first thing I found was called a CATS software. It's offered by the Cycles Foundation for Research. It's free. It's actually pretty difficult to use because it's sort of a DOS-based cycle tool, and you have to load the data manually, but it's definitely a good one. All the examples you saw today were based upon my good friend Lars Theoden's algorithm engine. His website is whentotrade.com. It's primarily based off a Fourier transform function. Another useful one that I use often is SR Analyst eSignal cycle tool. For those of you who are kind of purists who like the fixed cycle method, there's a great tool by Sentient Trader. This is primarily based off the Hurst method. And then John Eller's method, the MESA software, is also very good. There's also classes that are offered free online through Stanford University. I think they were trying to compete with MIT, trying to educate the world for free over the internet. And I found some good classes on Fourier analysis. If you want to get a little bit more deep into the math, this is sort of the website that I found. And then lastly, these are my contacts if you'd like to follow me on Twitter or ask me any more questions. I'm just going to go through 3 more slides that I have because I know they'll be relevant, and then I'll open it up for questions. The slide is basically TLT. I wanted to show a live forecast of the Treasury curve, or just the 10-year TLT. We do believe we've seen a bottom in February, and you can see we bounced quite nicely. It wasn't the ultimate bottom, so I just wanted to point that out. This is very relevant in cycle analysis, where the bottom in the cycle will most of the time happen a little bit earlier, and then we use technical tools just like any other trader to confirm the trend in order to take these trades. So obviously using trend lines or some type of oscillating crossover to enter the trade, not just blindly using the cycle forecast to buy or sell the market. The next one is gold. Everybody was asking me this week about gold, and I thought this was really interesting because previous to the last couple of days, we've actually been pretty happy about how the cycles have been forecasting gold. You can see that it had a nice forecast of the top in February. We actually had a cycle inversion here in June. August, we got a low. September, we got a nice little high right on this peak. We also got a minor high here in February. And we actually thought the low was in March. We thought we were going to trade up until May, and then the ultimate seasonal low happened in June. But we have this huge energy release right here to the downside. And so this is what I was talking about, the scalar wave that somewhere in the in the third axis, the z-axis, the energy was being pent up and it got released in the last couple of days, pushing it way beyond the forecast. And so this is possibly one of the reasons why we've had such a dramatic move in gold and silver metals markets. So last little chart, everybody's talking about Apple. I always like to show this one. We do have a forecast low here for Apple. The major cycles do point for it to start kicking in and getting some support up until June, July. This is a little bit against the S&P forecast, so we're not quite sure if this one's going to hold. If I'm looking at the S&P and I'm looking at Apple, I'll probably like to go with the index more than with the individual stock. So I'm definitely a little bit cautious, but we are cautiously bullish with the price of Apple going forward. So I'm going to answer some questions now, and it looks like they're coming in. First question: what would you consider a fundamental sine wave cycle? Would a presidential or four-year cycle be considered a fundamental sine wave? Yeah, I believe that does fall into categories of fundamentals. People like Charles Nenner and Martin Armstrong, they have applied cycle analysis to a broader spectrum of data sets rather than just price action. They look at, birth rate cycles. I know Harry Dent looks at birth rate cycles, population cycles, planting, yield, crop yield cycles. I mean, pretty much anything can be applied as long as it's used the same type of analysis techniques. Does cycle analysis work better in certain securities? I've found that cycle analysis has pretty strong forecasts in foreign exchange markets and in indexes. And I believe this is just because it's a summation of a huge amount of stocks for the indexes, and there's a lot of volume, so it's composing the biggest psychological factor in the indexes. And with Forex, I found it's really useful because the foreign exchange markets are open all the time. And so you don't get any gaps in the data, and so the data seems very fluid. And so the cycles seem to work very well in Forex markets. Have you observed that Fed's QEs are timed to offset the S&P cycles over the years? I have actually seen a chart of the Fed's actions, and they're very, very peculiar in that they do start to happen at interesting points along the cycle curve. So that I have noticed that, yes. Next question is, can one learn to create and implement cycle analysis without being a mathematical genius? I'm under the impression that I'm getting this involves advanced mathematical programming or analysis. Can a non-math whiz CMT learn to build a cycle composite? Yes, you can. I'm not a math wizard in any sense. There's a few ways that I was starting to do it in the beginning. One was using the free CATS software component, and this is just a frequency analysis software. There's pretty much no programming involved. You just tell it to analyze the data, and it spits out the spectral analysis or the actual frequencies in the market. The tool that I use primarily is a When to Trades tool. It's been built for using financial markets as the primary source of the data. So trust me, I'm not a math whiz. I'm very, very novice at programming, and I still seem to get by. It's just to understand the fundamentals of how these cycles work is more important than really the math, because how they behave and affect each other is going to be more important than tweaking the actual pluses and minuses within any type of equation. What books do you recommend? Well, I recommend all the books by the previous authors that we looked at. Let's see if I can go back. Any one of these authors are definitely interesting. My favorites are by Lars, and these are must-reads by J.M. Hertz. And I believe that William Garrett's Torque Cycles are a very interesting book as well. So I actually say all of these are sort of mandatory if you're looking at ways to enhance your cycle analysis understanding. Have you found consistent numerical periodicity for the broad market that is unchanging? Yes, we actually have found dominant cycles. So today I only really talked about one tool that we use, which is the cycle composite. There's actually another tool that we use a lot called the dominant cycle swing. It's called the dominant cycle swing. And what it is we actually take the two most strongest cycles that are relevant in the market, and we found that these ones that have very, very high Bartel's tests are very relevant for short-term trading. So we usually find there's a cycle between 35 days and 40 days in the S&P that it undulates between 30 and 40, but it keeps a consistent above 80 Bartel's test. So there's sort of a institutional time frame of 35 to 40 days, and it swings back and forth. And for the long term, we found a long-term cycle that's anywhere from 90 to 125 days. So that again is probably institutional cycle, and again that has very high statistical significance, but it stays in between those time periods and it rotates back and forth. So that happens a lot in a few different markets. Some markets, they don't have that. Have you done any correlation of your cycle analysis with Elliott waves on the S&P and equities? Yes. So cycle analysis, at least in my model, is used to plan trades. Another component that I use a lot is Elliott waves and harmonic market formation. So butterflies and Gartley patterns are very, very important to our trading decisions. Our cycle analysis is more our forecast. We're trying to figure out what type of way we're going to use options in order to trade the next trade. We look at Elliott waves in a couple different ways. We always consider a few different counts, and we're always considering every option when we're analyzing the markets. I believe applying cycle analysis of a double smooth OBV or TSI indicators would prove useful. The double smoothing provides signal line crossovers, and what do you think? Also, for power cycle oscillations slide, it looked to me as if the cycle itself was short-term smoothing standardized moving average of the price data between the two trend lines you drew and the cycle lines. Both questions, yes. If it is, I can do a rudimentary cycle analysis on my Wordins charting service. Yes, I mean, yes to all questions. We are doing cycle analysis on indicators, and we are optimizing indicators to the cycle. So there's actually a indicator called the cycle swing indicator where we take a smooth momentum oscillator and we apply sort of a periodicity of the main cycle to it. And so when you get a low crossover, you know it's especially strong because not only is it behaving very well to actually the price action, but also the cycle data is telling it that it's at a low point as well. So we are experimenting with that as well. The thing with trying to do cycle analysis without some type of scanning engine is you're leaving too much, in my opinion, to the subjective human eye. So when you're trying to count, this low, this low, this low across time, it's a little bit subjective, where in the way that I showed you, we're actually using a mathematical function to say this is where the cycle is, whether you like it or not, whether you can even see it there. So I think they're a little bit different, but it is possible for sure. Can you give us an opinion on where we are in this economical cycle after 49 months going up? Well, there's a couple bullet points to that I'd like to say. I'm a huge GAN guy. I do a lot of GAN work on the markets, and the GAN cycles are, in my opinion, pointing to the market being very near a possible larger trend change. If you look at GAN's courses, he has some basic rules on how the markets move up in 3-year components, and they move up in 6-year components. So I would say keep a very good eye out for some of the GAN time and price things. I don't think we're going to have a huge crash or anything, but I do think that the market is a little bit overextended as far as price and time. I try not to have an opinion on whether or not the market should be here or the market should be there. I think that really doesn't help in trading purposes. I really try to take the most objective look at where the price is going and how the trends are forming. So right now we do not have any real evidence, in my opinion, to the market being in a downtrend. But as far as timing tools, we are looking at evidence. We're trying to find evidence that the market should be turning at this point. So that's about it. Thanks for the questions. Again, I'll go to my contact information. If you have any more questions, please feel free to email me, alex@aetheranalytics.com, and you can follow me on my Twitter, Interest Rate ARB. Thanks, guys. I hope you had a great time, and thanks to the MTA.
And on behalf of the Market Technicians Association, I'd like to extend our sincerest thank you to Alex for spending some time with us today and giving us a fantastic presentation. As I mentioned earlier in the presentation, a copy of this webcast will be available in the MTA's on-demand video archives and in the MTA knowledge base before the end of the week. With that will also be the accompanying slides. If you do have any additional questions, and I know there are tons still filtering in, you can connect with Alex on his Twitter account @InterestRateARB. That's in your main chat. It's on your screen right now. Feel free to tweet your questions to him directly. Alternatively, you can visit his website directly at www.aetheranalytics.com. Again, I posted that in the chat. In closing, I'd like to thank each of you for attending today. Without your participation, we could not run these webcasts so successfully each week. For the Market Technicians Association, I'm Shane Squarick.